We live in a fantasy world now. Reality has been destroyed.
This is the time that you really need to pay attention.
The probabilities are overwhelmingly on gold's side. That is the best environment to see gold increase its value.
Welcome to Palisade's Gold Radio. I'm your host, Tom Bodrivix. Joining me today is Lawrence Lepard from EMA2 Equity Management Associates. Larry, how are you today?
I'm great, Tom. Really nice to be back with you. I always enjoy these conversations.
Absolutely, me too. And, it always seems that we feel like we have something almost looming and extremely important to talk about. And I think all of it really is important to talk about, to understand this roadmap, to understand these signposts of how we got here and where we're going. But I wanted to start today, Larry, with talking about the Fed and if they've now, in some ways, kind of accepted a higher inflation rate than their target 2%. Why do you think these rate cutting expectations have gotten so high for July and into the end of the year here?
That's a great question, Tom. And I think it's pretty clear that they're moving the goalpost a little bit. And Powell has foamed the runway when he said several times, we don't need to wait for the inflation to get all the way to 2% to cut, as long as we feel like it's going there. And of course, this gives them a lot of wiggle room. But I think, he sees what you and I see, which is that the higher rates are causing the U.S. interest expense to blow out. I mean, that chart of, the U.S. federal government interest expense has just kind of gone almost parabolic. And I think we're running at over a $1.2 trillion annual rate. And that, just helps the budget deficit. I mean, the budget deficit this year is currently by the CBO projected to be 1.9 trillion. I think it'll be larger. Mm-hmm. And so, I think we know Powell's aware that it's unsustainable because he said that. And I think in the back of his mind, he's thinking, how can I help out the Treasury and the federal government here? Because if we keep these rates too tight for too long, this is going to blow out and we'll hit a death doom loop. He also is aware, and I think, and rightly so, and I see it too, that there are signs that the economy is starting to slow down. I mean, I wouldn't say they're, compelling, but, consumer expectations, the SOM rule, which talks about unemployment ticking up, and some other things are beginning to show, what I would call leaks in the economy. David Rosenberg, who I think is a very good economist, has shown some charts that basically say, we are either in or on the cusp of a recession. And so I think Powell sees that too. And he's thinking to himself, I've been behind the curve with all my other moves. Maybe I should get in front of it a little bit. So I guess it's a combination of all of those things.
Mm-hmm. Well, with this idea of the dual mandate that they have, the other arm of that is to maintain high employment, right? So is it possible that they're starting to look at that, starting to look at the fact that every revision that they've made was always lower for the last, couple months? And with this recognition, maybe that he's actually trying to not be completely behind the eight ball this time, is the employment picture, is that something that he can...
I think that's got to factor into it. And of course, he's got the hardest job in the world. I mean, he's got a ridiculous job, but the numbers are all made up. I mean, and so... but I don't think anybody trusts these government numbers, probably including him. And so, your point is very valid though about the continued revisions. I mean, and they, they have a birth death model in there. They have all kinds of things in those BLS numbers that are just absolute horseshit. So, it's a very interesting economy. I mean, I think it's kind of a two-tier economy. And sadly, I think it's an enormous part of this country and Canada and other countries that's hurting very badly as a result of the inflation, all the problems we've had. But there's a certain segment of the economy, maybe the upper class, upper middle class, that's kind of hanging in there. And so you kind of see two tiers. I mean, we had in the United States recently, we had record, aircraft boardings over I think the 4th of July weekend. And so, yeah, right. I mean, and that, that's not a recession, or that doesn't, but again, the people who can afford to fly are probably the top third of the country. I think the other 2/3 are hurting pretty badly. So, he the employment picture is not as good probably as has been reported, and the revisions, as you point out, are probably the cause of, give you the clue to that, is in my sense.
Mm-hmm. Well, it's interesting, Larry, as we're thinking about this verbiage that Powell was talking about higher for longer, right?
Yeah. Yeah.
We hear that, and the biggest, let's say, expectation or number of rate cuts that I've seen would be 8 going into the end of the year here, which, if, at a 25 basis point per cut rate, would only take us down to 3.25% to 3.5%. So in some ways, does that end up kind of satisfying both of those conditions? Because we're still higher than we previously were. However, we've eased financial conditions enough, hopefully, to try and avoid some of this discomfort or this pain that Powell is seeing.
Yeah, that's a great question. There was a time when that many cuts were on the board, and over time, the dot plot now shows them with that many cuts. But actually, it's at a much slower rate. The FedWatch site has shown that the market is saying there's about a 90% chance of a cut in September. There's some people who are saying, and actually they were calling for it. I retweeted this morning. Nick Timiros retweeted a guy, or talked about a guy who was calling for, why delay? They should cut at the July meeting. And I suppose that's a possibility, although the market's not expecting it. Mm-hmm. Yeah, I mean, it's a great point. I mean, the other possibility would be that rather than do a 25 basis point cut, they would do a 50 basis point cut, right? And so you'd only have to do 4. Look, they're very unpredictable, and they lie a lot, and they can change on a dime. And, it wouldn't surprise me actually if they do a July cut. I mean, if they do that, the stock market's probably going to rip, or continue to rip, as it's, hitting record highs right now. So, look, it's impossible to know what these folks are going to do. It really is. Mm-hmm. I mean, with the exception of the fact that we know that they are going to cut, they have to cut. And then the other piece I would say that's not impossible to know is that something is going to break, some rivet is going to pop and cause them severe problems, similar to Silicon Valley. And we're going to go into kind of what I call the big print. We're going to have a crisis that's going to look like 2008, only larger, because the 2008 crisis was focused on, the banks and the housing market. This is really what I call an everything bubble at the sovereign credit level. And when this one goes, the currency is going to go. So, the Fed balance sheet is going to go from 7 trillion to 25 trillion. And inflation is going to roar. So, we've shifted gears. We had a great 40-year deflationary run from the early 80s when Volcker took control to, 2020, March of 2020, when the 10-year was trading at 50 or 60 bips. Since then we've entered an inflationary world, and it waxes and wanes. We went up to 9, we're back down into the 3s. But in my opinion, the next wave is coming, and we're probably pretty close to it. And the reason I say that is you can see it in the moves of the precious metals. Gold is bumping right up against its all-time highs, and silver is broken above that kind of critical $30 level, and I think is headed to 50 and then higher. So, and to me, these are good leading indicators, because these metals smell it. They know that the Fed is trapped. The Fed's going to have to print, and they can smell it, and they're front running it. So it's coming. But as we talked about pre-show, I've been terrible about predicting the timing. I mean, I thought it would have happened by now, and I've been just don't listen to me, because I don't know what I'm talking about. But it feels to me like it'll happen within 2 years, and it feels to me like it'll happen the front end of that 2 years. But I've been wrong a lot, so I wouldn't count on that. As you said pre-show, they're pretty good at kicking the can, right?
Yeah, I think a lot of people underestimate the amount of tricks that they have in their bag to be able to throw at any of these problems. Yeah,
they control a lot of stuff, and they can create all kinds of programs. I mean, I've heard from a friend in DC that, who knows some people that work at the Fed. His belief is that they're kind of working on a CRE bailout program. I mean, the next potential financial problem in the United States, as I see it, as I think a lot of people see it, is that commercial real estate in the United States, office buildings in particular, as a result of things like the Zoom that we're doing now, these office buildings have really lost a lot of value because people aren't going to the office as much. And you're seeing enormous write-downs on buildings all over the country. And those write-downs, often the debt on those buildings is held by regional banks. And so if you look at some of the charts, there's probably a $600 billion hole in a lot of regional banks spread out amongst the regional bank balance sheets. And if all those buildings were to suddenly have to refinance and get marked to market, we'd have some more Silicon Valley Bank-like problems. And so my sense is, what I've heard from my friend in DC is that they're kind of working up a program along the lines of, TARP or whatever, which would be maybe a regional bank could put the loan on a property to the Fed. The Fed would buy it, give them 100 cents on the dollar, take over the property, and try and manage it and work their way out of it, like they did with the S&L crisis. So yes, they have and are always devising new tools to keep the system going. But the one thing you and I both know, and everybody probably watching this knows, is those tools involve printing money. Full stop. I mean, if they're going to bail out bad regional bank loans, the only way they do that is by printing money to cover the loss on the loan. Mm-hmm. So,
Larry, one of the things I've been thinking about with, let's say, the political events of the last couple of weeks, if you take into account the debate and also what happened over the weekend with let's say the assassination attempt on Trump, without getting into the minutia around that situation. But, the Fed always tries, ideally to be apolitical. And
right.
I've spoken with several guests, going into this election, it feels like, or up until a couple of weeks ago, it felt like the Fed can't make a move one way or the other without risk of being accused of trying to favor one side or the other. But now that it seems this, tons of this political momentum has really shifted to one side, is it possible that provides the justification and the cover for the Fed to make any moves that they deem fit before the election?
I hadn't thought about that, but I think that's a really good point, actually. I mean, if it seems pretty obvious that Trump is going to be president, and I think to any observer today, that would seem fairly obvious. It's a good point. I mean, just to, reflect on what happened in my country in the last 2 weeks. I mean, awfully sad, stunning, and just bad stuff. I mean, the kind of things that happen in a fourth turning, and, two instructive, lessons here. I mean, one, the Biden thing and that debate, to me, that was a perfect example of the common knowledge game where, a lot of people knew that Biden was losing it, and just as a lot of people know today that the financial system is messed up and that there's an underlying problem here. But it didn't really get crystallized in people's minds and kind of widely known where everyone accepted it. Until he got up in that debate and looked, so feeble and incoherent. And so, that's kind of what, we all in the sound money world call, it's kind of, gradually and then all at once, right? I mean, gradually people have been saying Biden was losing it, but boy, that debate crystallized the issue, right? Mm-hmm. And then, the Trump thing was just horrific. And, the notion that our Secret Service can't do a better job of protecting a president, I mean, again, just, more example of, dysfunctional, failing empire. I mean, this is end of empire kind of stuff, and it's tragic and sad. And so, but back to the Biden thing. I mean, I think what's going to happen is, I think that, I mean, you see guys like Jay Powell saying the fiscal situation, the debt and the deficits, this is not sustainable. And I mean, this is the guy who runs the Federal Reserve, and he's saying it, he's admitting it, right? Okay, and so I say, okay, sir, so what are you going to do about it? I mean, what's the solution? Where are we going? And he doesn't have one. He just kind of no bids it. And, and you see other elites, El Ariane and others, Larry Summers and others saying this is not sustainable. And, it's kind of like, okay, everybody's going to be saying it's not sustainable. When is somebody going to say, okay, and therefore, we're going to have a currency event, right? I mean, and so I don't know what it is that's going to crystallize that currency event. I don't know what the quote unquote debate, item is. I mean, in the case of Biden, it was the debate that crystallized it. I mean, I don't know what the event is that's going to crystallize it here, but I believe that the event's going to get the event's going to happen, and there's going to be kind of an aha moment where, the world was one way before that Biden debate, and the world was another way after that Biden debate, Silicon Valley Bank, the world had a view of Silicon Valley Bank before they sold some bonds at a discount. And, the people pulled out their pencils and said, oh my God, this thing's in deep shit. And the world, and Silicon Valley Bank was gone within 2 weeks. The world was deeply different after that. And so we've got kind of, let's map both of those examples to, the fiat system is broken and the government is running a deficit that it cannot continue to run without bankrupting itself and having a death spiral, a la, Venezuela or a third world country. And yet, and some people are aware of it, and some people are even talking about it, but it hasn't been fully crystallized across the spectrum.
Mm-hmm.
But it will be. It will be. And my sense is that, Powell has not encountered his deer in the headlights moment yet. He thinks he's still winning. He thinks he can keep it going. They feel like they've got the tools to pull levers and make it all hang together. But I think at some point, something will break and we will have another situation where Powell becomes like, Bernanke was, he'll be the deer in the headlights. And God knows he's going to just have to turn that printer on, at super speed and because otherwise, as they said in 2008, the ATMs won't work.
Mm-hmm.
And that's what they'll use to justify it. And they'll say, very much similar to COVID, they'll say, who could have seen this coming?
Yeah.
Right. And that's always the excuse. So, I'm not suggesting I know when it's going to happen because I sure don't. But what I am suggesting is I know that mathematically that kind of thing is what has to happen and will happen at some point, in my opinion.
Well, Larry, that's exactly where I wanted to go next. Like our discussion about cutting rates, going back to QE, is this all kind of a moot point because, mathematically we're in a situation where the debt is now taking over a gigantic amount of the yearly budget. And we can't run the country without blowing out a deficit every year anyway. So like, it doesn't seem that there's any tenable solution to this. And as you say, there's no recognition or even acknowledgement of that problem from the highest levels.
Yeah, I mean, it is. I mean, yes, almost no matter what they do, they're screwed. I mean, the Titanic is sinking, and so rearranging the deck chairs isn't going to make a big difference one way or the other. To use a metaphor. But the path is uncertain. I mean, they can do things to kind of kick the can, and they, as you and I discussed, they've been pretty damn good at it. I thought Silicon Valley Bank would throw them over the edge. It didn't, and so they have a CRE problem. They'll bring out a CRE, rescue facility. I mean, we don't know the path, Tom, but we do know the general trend, and we do know that yes, and we know that because of the math behind it. I mean, it's compelling math. I mean, the debt, and you look at the curves on the debt, you look at the curve on the interest expense, and it truly is a perfect example of Stein's law, which is if something cannot go on forever, it will end. Mm-hmm. And so yeah, I sometimes I tire of just trying to figure out which move they're going to make, and are they going to cut or not cut, and is it 3 cuts or 8 cuts? I mean, it almost doesn't matter. It really almost doesn't matter. My time, I think, is more productively spent on trying to figure out which form of sound money I want to hold at what period of time, and how I want to balance my sound money holdings between gold, silver, Bitcoin, and gold and silver mining stocks, which I happen to see right now as probably being the most asymmetric bet. I mean, I think the silver mining stocks right now look better than absolutely anything out there. I mean, silver has been massively suppressed. It tends to outperform gold in bull markets. We're entering a bull market. It's got two pieces of demand. It's got the monetary demand, which is somewhat less than gold because it's been demonetized to a degree, but it's also got enormous industrial demand. We've been running a deficit for years. And by the way, all these things I'm going to talk about, my partner and I are going to talk about in our second quarter letter, which should be released within a week or so. And it's free. It's on our website. Solar use is growing for silver. To me, my target is $75 silver, $100 silver within a year or two. And I've got companies that are mining 3 million ounces of silver at a $20 all-in sustaining cost. And, guess what? At $100 silver, those companies are going to have profits that are just going to be out of this world. And so, to me, as I look across my portfolio, probably the one area I'm most excited about are my silver stocks. I see 5, 10, 15 baggers laying all over the place. So,
Larry, but before we go too far down that road, which
sure.
Absolutely we will, but I just wanted to kind of finish up on a bit of the macro side. Like
macro, sure. Go back to macro. Yeah.
The idea that, we can kind of take some of these signals from the markets. What can we learn from the bond market right now as a signaling tool? And what, maybe the structure of the duration of bonds and bills that are being issued right now, what is that telling us?
Yeah, that's great stuff and a good question. So one thing we've seen that the demand for the longer duration coupons, 10 and 20-year bonds has fallen, and they haven't been issuing as many of those. And we've been doing a lot of short-term financing, which frankly is what third world countries do when they're, in debt spirals, and we appear to be close to one. So there's that, and that's a clue. To your bigger question of what does the bond market tell you? I mean, honestly, I think the bond market's kind of asleep. I mean, if you look at the term premiums on the 10 and 20 years, I mean, and I know there's a school of thought that says that the economy is going to roll over, and that therefore these bond yields, and historically, when the economy rolls over, you want to buy duration because bond yields go down. And I think I think it's very possible that for some brief period of time that does happen until the big print occurs. Mm-hmm. And so, I know smart bond traders who are saying, yeah, you're right, longer term, but short term, we could get lower yields if we really do fall into a recession. So, the bond market is, in my opinion, it's useful information, but it's not always correct. Mm-hmm. And I think that people, I think that at a bigger macro level, I think the mistake people are making, Tom, there's a guy named Farrell at Merrill Lynch who used to say this, they're investing the way they invested for the last 40 years. And we're not in that environment anymore. We're in an inflationary environment. So you got to pull out the 1970s playbook or the 1940s or 30s and 40s playbook, and 40s really, because, in an inflationary environment, bonds are death. I mean, certificates of confiscation, as Henry Kaufman called them. So, but there's enough muscle memory around that says, okay, pretty high bond rates, slowing economy. Oh, I know what I should do. I got to buy bonds. And for a while, it's going to work. If we really do get a slowing economy, there will be a bid into the bond market. But I view it as picking up nickels in front of a steamroller, because I think when the big print comes, the bond market's going to get annihilated and by the way, the bond market has been annihilated. I mean, and this is in our report. I mean, the 20-year is down. You've lost, if you held the 20-year at the beginning of this tightening cycle, or, at the top in 2021 to today, you've lost 50% of your principal. I mean, this is supposed to be a very safe long-term government security. I mean, losing 50% of your principal over 3 years is not exactly safe. So, and I think that trend, over a longer time frame, I think that trend's going to continue. Did that answer your question?
Yeah, absolutely. Well, okay. When we're thinking about these signaling mechanisms, does the stock market really show us the same thing? With the amount of concentration up in a couple stocks, is this showing us very similar trends to previous bubble tops?
Absolutely. I think that's a great question. I think that's absolutely true. I mean, John Hussman does fabulous work on this, and I recommend his site to anyone who wants to study just how crazy and overvalued the stock market is. Again, I talk about this in my letter. I mean, I believe NVIDIA today is selling at close to 40 times revenue. And I recall very clearly, because I was involved in the markets and investing back in the 2000 timeframe. At the peak in 2000, Cisco Systems was selling at 31 times revenue. Mm-hmm. Which Cisco was the leading manufacturer of routers, which is the core, the basis of the entire internet growth, build out. And so, and when that bubble burst, Cisco lost 80% of its market cap. And look, I don't dispute that AI is going to have a meaningful impact on our world, but I tend to think that we've gotten a little ahead of ourselves here, and it's not going to have as big an impact as that market cap is suggesting. but, woe be it for me to suggest it's not going to go higher. I mean, that somebody, I think Hussman said it, the problem with bubbles is you can either look like an idiot before they burst, or you can look like an idiot after they burst, in the sense that, okay, this is too high, I'm going to short it. Well, it keeps going higher, you look like an idiot. Or no, it can continue to go higher and you hang on to it. Well, it eventually bursts and you look like an idiot. So we really don't know where the top of this stock market is. David Hunter, who I think is very smart, he thinks it's around 7,000 on the S&P 500. And you know what? He could be right. I mean, I frankly have been arguing with him for a couple of years. I'm beginning to think he might have a point. Who knows? But, at some point it will end. We do know that. Trees don't grow to the sky. I recall very clearly sitting with my partner in March of 2000, and he and I looked at each other and said, are we the only two guys left in the world who think companies or stocks should be valued at some multiple of cash flow? Because everyone's valuing them based on eyeballs and clicks and, the future of the internet and all that stuff. And but to be honest with you, I couldn't see that was the top. In March of 2000, I thought, well, this might go a lot higher. And it didn't, but that was just the timing on it. And as I say, with respect to this market, it could go a lot higher. So I'm not short it, but I sure wouldn't want to be long it either.
Well, something that I mentioned to you before we started recording as well is that, this idea that it's overvalued by any metric. But if we do go back to, crazy QE, stimulus, lower rates, that currency has to end up going somewhere, and very likely it ends up back into those stocks.
It's a great point, and that's actually David Hunter's point, that we're about to enter a cutting cycle, and that's going to drive another round of higher. And you know what? You guys are probably right. I mean, I kind of feel like we're close to a top, but I've felt that way for a while, and I've been dead ass wrong. So, yeah, you guys are probably right. I mean, in a sense, it's almost starting to look like what von Mises called a crack up boom, right? I mean, it just, everybody, as more money goes into the system, it has to go somewhere, and it goes into what's been working. And the stock market's been working. I mean, the stock market's up 80% since 2020. I mean, it's incredible. I mean, there are people who've been, 2008 was a long time ago. Was it 15 years ago, right? And so if you haven't been in the market more than 15 years, you've never even seen a bear market, a real bear market. All you've seen are some dips, and it made sense just to buy them, And I'm here to tell you, having been in the market since the 70s, that bear markets are real. They do occur. Now, it's been a while since we've had one because we've been blowing one hell of a large everything bubble, but that doesn't mean we're not going to have one in the future.
So we're talking a lot about the US, which obviously has a big bearing on the rest of the world. But is it possible that there are other countries, like let's say Japan or China, that are facing worse problems despite what we're looking at right now?
I think that's right. And it's very easy to sometimes not necessarily look around the world. China's got a lot of problems. They've been growing their money supply even more rapidly than us. That's another chart that's in my letter. They got a lot of political problems and so forth. And more particularly the one I think we talked about that really is worth focusing on, because I think it could be kind of a canary in the coal mine, and that's Japan. The Japanese have been leaders in this zero interest rate policy and this growth and debt, and they've gotten away with it because they had a culture of saving in their country, and they also had a positive trade balance, which we don't have. But, as we've all now noticed, the Japanese yen has really started to fall, and it's broken through a critical level at 160. And Japanese interest rates have started to go up. And, this is problematic. And Japanese inflation has started to go up. They had very low inflation. Last reading I saw was close to 3%. And so, this is all starting to become a problem for them, in particular because they have to import a lot of oil. They don't have any natural, oil on their own. And so, and they used, because of the US dollar system and the petrodollar, they had to buy that oil in dollars until very recently. And now there's beginning to become evidence that suggests that, the Middle East is going to sell to them in yen. And to the degree that they don't use that yen to purchase Toyotas or other things that Japan makes, they'll just net settle in gold, which, by the way, is another huge trend that's taking place right now. I mean, to me, it's really enormously interesting that gold is hitting new all-time highs, and that ETF demand in the West, in the US and in the UK, is falling. All this demand is coming from the East, from the Far East. And, it's very clear to me that when we, weaponize the dollar with the seizure of the Russian assets, we kicked off a BRICS trend towards net settling trade in gold. And that's part of the reason why gold is hitting the highs that it's hitting. And I think it's a trend that's only going to continue. It's going to run many, many years. So, I think it's interesting. I mean, until very recently on Bloomberg, all the projections by, most analysts were that gold was going to trend back down to 1900 or 2000, which is where it was before this breakout. And I think the odds of that happening are very, very low, if not zero. Personally, I think gold's going to 3,000, 4,000, 5,000 over the next few years. I mean, at a minimum, it'll be 2,500 to 3,000. So, and in that instance, the silver and gold miners are going to do extremely well. I mean, we don't have the first quarter, the higher prices weren't all the way in the first quarter. Gold didn't break out until the last part of the first quarter. But I think we're about to be shocked by some of the earnings on these miners. I mean, the second quarter, the average price of gold, I think was close to 2,400, just below it, maybe 2,370 or so. And when that filters through, the mining community and all, ASICs haven't gone up that much. And so, we're going to have some blowout earnings in these miners. It's going to wake some people up, in my opinion.
Mm-hmm. Well, Larry, when we're thinking about these bubbles, these everything bubbles popping, does this end up, in some cases, destroying a lot of capital? And if so, how do we end up getting that rotation into the hard assets that we need and that we're so convicted that are going to benefit from this?
Well, you're right. I mean, to the degree, when a debt defaults, that does, destroy that capital. The money goes to money heaven, and there will be a lot of that. We're seeing that occurring right now in commercial real estate, right? But it's really more a matter of what'll happen. The remaining capital that's still out there, the stocks, bonds, et cetera, I believe will rotate, and the allocations to gold and silver miners are just so extraordinarily low. And the entire sector, we've got a $130 billion U.S. stock market, and the entire gold sector, the ETFs are I'm sorry, when I said 130, I meant 130 trillion, not billion. The ETFs are a couple of trillion, and all the stocks put together are maybe a trillion. So, but those, all that allocate, all those, the 130 is all allocated to the S&P because the S&P is working, and people don't get fired for buying the S&P index. Wait until the S&P index breaks and it starts to not perform well, and wait until the gold and silver mining stocks beat the S&P convincingly for a couple of years, and not the entire 130 is not going to come chasing after the gold and silver mining stocks, but we don't need that. All we need is a percentage of it. All we need is 5 or 10% of it to say, hey, you know what? These S&P stocks aren't performing so well, and those gold stocks are doing extremely well. We're going to shift our balance and buy more of those. So, and that's what will happen. I mean, but right now everybody's still infatuated with a shiny object, and the shiny object is Nvidia and the S&P hitting record highs. And we need that to change, but it will at some point.
Mm-hmm. So, Larry, getting to the metals here.
Yeah.
Do you have a feeling that once we really see this start to accelerate and this recognition by, maybe a small percentage of the main market, do you have a feeling if gold or silver are going to start to lead that charge? Like, is there a particular order that this ends up unfolding in?
Yeah, I mean, if we look at historical examples of this, gold broke out first, silver follows, but silver will go faster and higher. And so with each wave, I look at gold as kind of the kickoff event, and then I look at the silver follow through. Silver's going to outperform gold, but it's also going to be more volatile. And so in my opinion, we are in we're in the heat of it now. I mean, if you're looking at buying gold stocks, I mean, to me, now is probably your last opportunity to buy them close to cheaply, because they're about to get a lot more expensive. I mean, I fully expect the GDXJ will double in the next 12 to 18 months, and probably the GDX will come close to that. And that's just because of the, higher metal prices and the larger earnings and multiple expansion. I mean, you really had kind of a perfect storm, Tom, of, the ASICs, the all-in sustaining costs were rising for the last 3 years. Expectations of future metal prices weren't going up. So margins were getting squeezed. And, you had very, very low multiples. And so, if you've got a company that can grow its production and then the margin is growing because you're selling gold at 2,500, not at 2,000, and your ASIC's gone up 11%, which is still an increase, but not, as much as the price of gold went up. And then you get multiple expansion. I've got companies trading at 3, 5, 7 times, 6 times cash flow. And we all know that in bull markets for gold stocks, they can trade at between 9 and 20 times cash flow. And so, what can happen here, in my opinion, very easily is we've got a lot of stocks that are going to be, 3 to 20 baggers. And, that the investing in gold stocks is a very tough business because it's the process of mining is a very tough business, as all those of us who are Victoria shareholders just learned the hard way. But having said that, there are periods of time when they do work and they work extraordinarily well. And those periods of time are when the metals prices are, when they've been beaten down and they're relatively cheap compared to the assets they hold in the ground, the silver and gold that they own in the ground, and when the price of the metals are going up very, very quickly, and the alternatives like the S&P don't look good, then gold stocks just crush it. I mean, the reason I got into this whole area was when the GFC happened. I went back, I realized we were going to have an inflationary world going forward. I was a little early about how big it would be, but and I went and I said, all right, if we're going to have an inflationary world, I got to study inflation. So I went and I studied the 70s. Well, in the 1970s, the gold stocks were the best performing category of the market by far. They compounded in the 70s. The gold stocks grew 34% a year, compounded for 10 years. I mean, that's unheard of. And so, in my opinion, what we've got is we've got a decade that's going to look like the 70s. We're a couple of years into it. We had a nice pop in 2019 and 2020. We've settled back in with a pretty good correction in 21 through just now. But the next leg is just starting. And in my opinion, this leg's going to run hard for a couple of years at least. And then we'll sort out and figure out, what's next. But, as I say, I think people who are looking at buying gold and silver stocks right now, your timing's pretty good, in my opinion. You missed the first move off the bottom. I mean, we're up 20 or 30% off the bottom, but that's okay. I mean, you now, in my opinion, have pretty high certainty that it's going to continue.
Mm-hmm. Well, when I hear this type of, let's say catalyst that we're looking for this revaluation of the metals mining sector, I wonder if, the main market ends up missing it because they're so worried about and focused on this growth side of the equation. It seems like a traditional valuation of a company that's throwing off a lot of cash doesn't matter anymore in this environment. So is it possible that we're in this state where that isn't even a
That'll
skill?
Prevail and cash flow will never matter? Yeah, I mean,
I don't know about never, but at this point, it seems like a difficult sell sometimes for that to be the catalyst.
I hear you. And they may never go back to the premium valuations that they've had in the past of 20 times, earnings or cash flow. I mean, I would accept that. Mm-hmm. But, a couple things will happen. One, cash flows will grow a lot. So you'll get appreciation because you'll have bigger cash flows. And two, worst case, they could start paying dividends, doing stock buybacks, et cetera. And they will go back to much more normal pricing. Mm-hmm. My partner was an investment manager with a different firm before he joined me, and they were in the oil trade. And he says this reminds him very much of the oil trade, in the early teens, in the 2012, 2013, 2014 time, where, oil companies were all trading at extremely low multiples. That, they were shitty businesses. Nobody thought they would ever go up. Mm-hmm. And they did. Eventually the market woke up and realized, and they did. But your point is a good one, Tom. I mean, they may never achieve premium multiples. That's a possibility. They may just trade as in, this is a tough business, and a 7 multiple is the right multiple. But even if they only stay at a 7, one, I've got some companies that are at 2 or 3 multiples, so going to a 7 would be a 2-bagger. But two, the E is going to get bigger because the price of the commodity is going to go higher, and so there's going to be a lot of growth in the earnings. So that'll still get your stocks to a very nice place. Maybe not the premium place that they were at in the past, The other thing, as I say again, though, when the stock market breaks, I think people will be going back to basics. I mean, 100 years of, a stock is worth a multiple of its cash flow. I mean, that's widely known and that's widely understood. And, look, we've gotten away from that. Right now, AI is exciting. And so NVIDIA, who cares what multiple of its cash flow it is? You just buy it because it goes up. But, that'll change. And when it does change, people will go back to basics, and basics are, okay, what am I paying as a multiple of cash flow? And so, we're going to be fine. But your point's a good one. We may never get to the premium valuations, and perhaps we shouldn't, because, it's a super tough business. I mean, breaking rocks is not easy, as anybody
but so necessary.
Yeah, that's exactly right. I mean, everyone wants clean this and clean that. Well, guess what? If you don't have lithium, you don't have batteries, you don't have electric cars. I mean, it's, all of the things that these base industries do are part of what allows us to sit here and communicate, via, the internet and technology. I mean, these technologies require the basic materials that get pulled out of the ground. I mean, I'm sure the computer I'm using has some silver in it, as does yours.
Mm-hmm. So, Larry, something I came across last week at a conference was this idea that, as you were kind of mentioning, if a company ends up paying out all kinds of dividends, would you find it more or less attractive if a company started paying a dividend, or even offering the option to pay their dividend in gold?
Oh, I would love that. Yeah, I would absolutely love that. And I would also love the fact that if companies did what some of the Bitcoin companies do, which is to say, if they had excess earnings that they didn't want to invest into repurchasing their stock, if they just held on to silver or held on to gold, just put it on their balance sheet. I mean, it's a much better treasury asset than cash. But yes, I mean, I would very much be in favor of that. I mean, I think, I think the companies are going to become more creative and more responsible and more attuned to shareholder interests. I mean, the last cycle where they all blew up in 2013, I think really taught a lot of these managers that they've got to be better stewards of capital. And hopefully that continues going forward, although probably near the end of this next cycle, there'll be a lot of nutty stuff being done. I mean, one of the things I find ironic, I mean, right now, the big companies should be doing M&A all over the place because there are really good things on sale, really good small companies that have a hard time financing themselves on sale.
Mm-hmm.
And of course, they're not getting scooped up. They should be. What'll probably happen as we enter this bull market and the price of everything goes up is, these larger companies will come back and they'll pay much higher prices for them in a few years, which is, of course, exactly the opposite of what they should be doing if they want to create shareholder value.
Mm-hmm. So, Larry, when as we're kind of talking about those particular aspects of a company right now that are very appealing to you, what other types of projects, let's say, are getting your attention right now? Are there any interesting strategies or ways of doing business that are grabbing your attention because of something that sets them apart as a strategy or a structure as a company? Or is it, are you just looking for resource base and operational ease?
Yeah, I can't point to, I mean, look, the streaming model is a great model. And, I have my mother in streaming stocks because they're low risk. The problem with it is that they're very fully priced. And so it's very hard to make multiples on those stocks. I mean, you make multiples, but not as big a multiple as you can if you take a company, a drill story that's discovering a lot of metal, or a development story that's turning a deposit into a cash flow stream. No, I mean, it's pretty just basic blocking and tackling, Tom. I mean, I like, my favorite sweet spot for companies is a company that has a mine operating and has positive cash flow. So they no longer have to go to the market to dilute the shareholders to continue their growth. Mm-hmm. And then they can use that positive cash flow to either, they can use it to discover more metal, so they extend their mine life. Then they can also use it to increase the capacity perhaps at the existing mine if that's warranted. And then finally, they can use it to develop another mine, an adjacent mine, or an entirely different project. And if they've proven that they're good capital allocators and they're good at development projects, we've seen companies grow from starting off with a very modest, and I also like the companies that can bootstrap themselves. I mean, they're companies. I mean, I look at one right now called Line One, which has started producing metal, and my sense is that will allow them to self-finance from here on out. There'll be no more dilution via equity offerings, and that's a good thing. The toughest part of the business is the development part of the business. It's the greatest risk part. I mean, the drill story part is risky too, but if you find something where there's the emerging good deposit and you buy it cheap enough, you can take a lot of the risk out. But trying to get from, we've got a deposit but no cash flow stream to we've got a cash flow stream, that's hard. Mm-hmm. That's extremely hard. But if you get it right, you get paid for it. But therefore, I tend to like the companies that have, an anchor to windward, which is to say they have one mine operating and providing a cash flow stream, but they're trying to grow, add more. Mm-hmm. So that to me is, I guess, the investment sweet spot of, picking mining companies.
Right, because you're almost combining strategies where you're almost trying to buy something that has the potential of being revalued as a low spot on the Lassonde curve,
exactly,
while it's also financing itself and not diluting the crap out of itself.
Exactly. You've got safety in the fact that you have one mine going, and you've got upside in the fact that you can grow. You could conceivably really rapidly grow your production by adding other mines. Mm-hmm. So you kind of got the best of both worlds.
One thing that I would like to get your thoughts on as well is this idea of the new Mexican president being a threat to mining. With those developments, Larry, did that shake your confidence in any of the projects in Mexico, or change the way that you look at it?
Another great question. I've spoken to a lot of Mexican miners and tried to get a read on her, and I'm cautiously optimistic. I think that she's not as extreme as AMLO was. She wants to see the country do well. She knows that mining is an important part of the country's, economic base. I believe that they will permit open pit mines if they're very well designed and clean. And I'm not terribly concerned. And perhaps I'm reading it wrong. Obviously I'm being told by people who have a vested interest in telling me it's all okay. So I do discount that a little bit, but I don't think, if you look at governments, what do they want to do? They want to stay in power. They want to be able to collect taxes. They want the people to be happy. Well, the mining industry in Mexico employs a lot of people. A lot of people whose livelihoods would be significantly impacted, diminished, hurt, whatever, if they were to shut down mining or shut down mines. And so I don't see them doing that. I think it's a, kind of a shooting in the foot sort of thing. Even AMLO, I think a lot of what he was talking about was very much, his populist rhetoric, right? It sold. The people liked it. I'm for the people. I'm against the corporations. Okay, mm-hmm. Fine. But at the end of the day, these guys know that they need, the revenues that this industry produces. So I'm not a bear on Mexico at all. I think Mexico will continue to do quite well, and I think mining in Mexico is perfectly safe and a good thing to do. There are other areas I'm a little more worried about. There've been some things happening in Ecuador that give me some concern. I'm not very much in Ecuador. I have one name that has a little bit of presence in Ecuador, but and I'm not too worried about Africa. It's ironic. As Rick Rule says, there's no jurisdiction that's safe. Biden was talking about trying to put a 6% NSR on mining in the U.S. Obviously he's never going to get that through, but the point is that as long as governments exist, all businesses are have risks associated with them because. Look, if we get into a big fiat crisis here where the money is getting printed and everything else, it doesn't strike me as beyond the possibility that, Canada or the United States would decide that they need to either, put NSRs on the mining business or even confiscate the gold mines and pay people for them. Mm-hmm. A public taking is not entirely outside the realm of possibility in my mind. hopefully, if it looks like that's the direction they're going to go, we'll be able to see it before it occurs. We'll get a wind of it and be able to, assess the risk and perhaps move away from it. But, as long as governments exist, all honest businesses are at risk.
Mm-hmm. Larry, one of the other things I wanted to get your thoughts on was this situation around the German government selling a bunch of Bitcoin that, as I understand it had seized. So can you fill us in on what happened there and, how they ended up with that Bitcoin?
Yeah, I'm not the expert on it. I really haven't studied it deeply. It was quite a bit of Bitcoin, though. I think it was billions of dollars worth of Bitcoin. It might have been 20,000 coins. Somebody will obviously in the show notes be able to put the exact number in there. Mm-hmm. And yes, they did seize it from some businesses that I think they believed were operating, illegally or doing bad stuff, kind of Silk Road sort of stuff. I mean, to me, it's going to go down in history like Brown's bottom. I mean, Gordon Brown sold all the British gold in 2000 at $260 an ounce, because he was probably told to by, the Bilderbergs and some other people. But I mean, the Germans are nuts. I mean, they're absolutely nuts. I mean, this is, it could have been a core asset for them, and I personally believe that Bitcoin's going to perform extremely well, and so. But I'm sure they had budget issues and things they wanted to spend it on and so on and so forth. And politicians don't understand what it is and where it's going. And so they just say, all right, let's sell this because we need the money. So, it probably had a dampening impact on the price. I mean, we all saw Bitcoin kind of got hit a bit, went down into the 50s, the low 50s briefly, and it's come back. But, to me, it's just short-sightedness on the part of that government. The U.S. still holds a fair amount of Bitcoin, and we've sold some of ours. I'm hopeful that maybe that will change. Particularly under a Trump-Vance presidency. Vance is a Bitcoiner. Trump has come around on Bitcoin. I'm not entirely sure how much he understands it, but I think he's learning about it. And I know from Jason Lowery, who was an Air Force officer that studied it and wrote a thesis on it at MIT. He's informed my partner that the Pentagon and the CIA understand the strategic importance of this form of money, and so if they have anything to say about it, we're not going to sell. The U.S. isn't going to sell the Bitcoins that it holds. But unfortunately, it might be a decision made by the Treasury or the Congress or the Federal Reserve, and that those people probably are not in favor of Bitcoin. In fact, I know they're not in favor of Bitcoin. So. Each government's going to have to struggle with it. I do find it very interesting. One thing you guys have probably noticed is that, Bitcoin and the crypto people who, kind of are on the side of Bitcoin, the U.S. government has started to it's become a big enough block that the U.S. government is kind of listening to it. I mean, so, Elizabeth Warren had her anti-crypto army and was absolutely determined to kind of shut it all down. And, when RFK endorsed it and then Trump endorsed it, Biden had to kind of back off and say, well, okay, we're going to reconsider our position on this because they came to realize that this is actually a meaningful voting block and they didn't want to lose that vote. Mm-hmm. And so, I mean, our democracy is definitely broken, but, in subtle ways, there's still parts of it that work. So. Mm-hmm.
Excellent, Larry. Well, I appreciate you filling us in on your thoughts on all of these topics. What are you working on right now? And what are you looking forward to for the rest of the year? So there are two
things. Yeah, thanks for that lead in on that. So the two things. One, I'm writing my quarterly report for my partner and I are writing my quarterly report for the quarter ended June. It will be out in a week. It'll be on our website, EMA2.com. And thanks for the prompt on the other thing. I'm personally writing a what I call a white paper, and the purpose of it, which I think I can complete in the next month or two, and it's going to be meaningful but not overly lengthy. It's not going to be a book. It's going to be something that somebody could read in an hour or two. And the theme is going to be, and I want it to be simple and clear enough. And the theme is going to be, why sound money is what will really fix all the problems the world is going through right now. I mean, I don't think there's anyone in the world today who would say we're in a good place. We've got, attempts at assassinating presidential candidates. We've got a demented, senile president. We've got, we got rapid and high inflation. We got all kinds of problems, and they're getting worse. And sadly, I think a lot of people are focusing just on the politics. They're missing the core issue. And the core issue is that we went off the gold standard in 71 and the money's unsound. And so the purpose of this white paper is to try and make that extremely clear and understandable to any level of education. You could be totally financially illiterate and read this and go, "Oh, I get it. This is the problem." And the conclusion is we need to return to sound money. And the way to do that, the recommendations, I'm not just complaining, I actually have a solution. And the solution is we need to make gold, silver, and Bitcoin legal tender so that there are no capital gains or sales taxes on any of those. We need to make them available for contracts so people can make contracts in whatever money they choose. There will be 4 forms of money. There will be the dollar, gold, silver, and Bitcoin. Pick whichever one you like, transact in whichever one you like, and let the best currency win. And then in parallel with that, we would do 2 other things. We would abolish the Federal Reserve and let all the banks fend for themselves. There would be no more bailouts. If a bank did stupid stuff and got over their skis in fractional reserve lending, they'd fail. And their depositors would be wiped out. And so people would have to become responsible about picking what bank they wanted to use. And then we would also abolish the Federal Deposit Insurance Corporation so that, because that's a huge call option on the government printing money, so that if any bank failed, the depositors would be wiped out. And the government wouldn't have to bail them out. And so if you did those things, I think we would very rapidly progress toward a society that's much more responsible and toward money that is much sounder. Because I think people, given the choice, people would choose sound money over this government fiat that's being printed to excess. And I think when we do all of that, a lot of the other problems that we see in our society would clear up pretty quickly. So that's the purpose of the white paper. It'll be on Twitter, and I'm thinking of just making it a PDF and making it free. I'm not in this to make money. I just want to spread the word, and I want something that people can refer to and go, "Oh yeah, that's it. I get it." And here's the case for this. Here's why Keynes was wrong. Here's why Krugman's wrong. Here's what the Fed has done. It's going to talk about all those things. So, thanks for the lead in on that, Tom. I appreciate it.
Of course. I mean, something that I think a lot about is how to try to reach more people with this message, to just even start the conversation about what is wrong with the money, about what path we're on, and about what people can actually do to understand these things. It's not that I think that I have to be right and here's why you need to know why. It's more like, hopefully we can kind of lead other people into this.
I think that's
this
right.
realization.
I think we got to make them knowledgeable. We got to create awareness, and then, like any other good idea, it'll just spread. People tell their friends that, "Oh yeah, that's decent." I mean, I hope I can do a good enough job on this that people will say, "Oh, I enjoyed reading that, and I want to recommend it to my friends." And
you shared with me that it was kind of sparked by another paper that was similar in the Great Depression, right?
Yeah, that's exactly right. Actually, it was pre the Great Depression. This is rather immodest because I don't think it could do this, but in the American Revolution, there was a guy named Thomas Paine who wrote a pamphlet called Common Sense. And it's not widely known, but it wasn't as if all of America woke up one day and said, "Hey, let's secede from Britain." You know what I mean? I mean, John Adams wrote that when the Declaration of Independence was written, 1/3 of the population was in favor of seceding, and they were patriots. 1/3 of the population was loyalists. They were like, no, we're British. We want to stay British. And 1/3 of the population didn't give a shit. They were just kind of like, whatever. We're farming, and I don't give a shit what the political system looks like. And to catalyze the piece that were the patriots, a guy named Thomas Paine wrote a pamphlet, and it was widely distributed. And it helped that third grow to the point where the United States formed a country. And that what we're talking about here, this return to sound money, this is a really, really big thing. I mean, we've been on unsound money for 50 plus years, and it's going to create a lot of stress and a lot of turmoil. But the quicker we do it and the more fairly and honestly we do it, the better off we're all going to be. And so, to me, if there's one message that I think everybody who listens to this could do, one thing everyone who listens to this could do would just be, get a great understanding of why this is the issue. The white paper should help, and then tell your friends about it. And let's create. I don't like Elizabeth Warren saying the the anti-crypto army, but let's create a sound money army of people, in the Western world who realize that the problem is that the money is what's broken, and let's go fix it. Let's go fix it. It's not impossible to fix it. If we made all these other forms of money legal tender, and if we outlawed the Fed, we could fix the money problem. We really could. And so that's the message that I'm going to continue to talk until I check out here, because I feel like that's the highest probability message for fixing what's wrong with this world. And I don't want to see all my kids are in their 20s. I don't want to see them and then the grandkids I'll someday have. I don't want to see them grow up in a world that's going in the direction we're going right now. Mm-hmm. So that's why I'm doing it.
Excellent. So for those that want to read Larry's quarterly newsletter, that's available at EMA2.com. That'll be up in a week or so. And of course, at Lawrence Lepard on Twitter or X. And we'll look forward to that white paper coming out, Larry.
Yeah, it should be in the next 6 to 8 weeks.
Excellent. Larry, thanks so much for your time today.
Thank you, Tom. It's always a pleasure to talk to you. Yes, great questions. Enjoyed it.
Thank you, sir. This podcast is for general informational purposes only. Nothing on this podcast should be taken as investment advice. Guests on this show are not compensated for their appearance. Listeners are urged to educate themselves and make their own decisions. Do not base any investment decisions on the information contained. To view our full disclaimer, please visit our website.